Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne Mann with David Engle.
Good morning. Let's get to your top stories today. Investors bracing for this massive parade of earnings out of China. As you can see on your screens here, a combined $3.4 trillion of market cap are set to report results later today. Now, stocks across the region gaining ahead of the China Open with mixed results from the U.S. tech and those firms in focus, of course, along with, of course, next week's election and also the upcoming Fed decision. And Beijing reportedly considering further stimulus with a fiscal plan worth $1.4 trillion to be approved as early as next week.
All right, we're just getting some breaking lines crossing through here. A statement from the Chinese on after what we heard from the EU, following through with these tariffs. So this is what the mainland response is here. They're seeking a resolution with the EU over these EV tariffs, and they're saying that EU technical teams are in a new round of talks. That's according to the Ministry of Commerce here. So it seems like at this right, they're still talking at this point, so maybe there's still room for negotiations here. But right now, we are seeing that they vow all necessary measures to defend firms' rights. That's the latest coming through in that statement. We'll see how the EV sector plays out here this morning. But the tech sector very much in focus, just given some of these U.S. tech earnings that we got overnight, which was a mixed bag, right? But still, we saw the NASDAQ hit a record overnight. That's thanks to what we saw with Alphabet. So it was almost like a beat on all fronts there when it came to even the core business surge. You take a look at how the cloud business is doing. So that certainly helped. But then again, you have AMD cutting their revenue forecasts as well. So how does that all square up in terms of the whole AI trade is one thing that we're focusing on today. Dollar is slightly on the back foot, but we're still talking about what Treasury markets are doing, which it looks pretty mixed across the curve here this morning, but we're still set for the worst month for Treasuries in 2 years. So that's certainly a milestone that we have to deal with after we count down to this election, of course. And you're starting to see more of these sort of Trump trades come through, right? So gold hitting a record, given just some of the risks that are out there. You take a look at Bitcoin as well. We're getting very close to that record as well. And dollar yen, we're at 153 levels. Credit Agricole had a pretty interesting call, Dave. They think maybe we could get close to 160 or test that if, in fact, we see a Trump win as well. The chip sector very much in focus, so we're watching very closely like that. Taipei opening up and still seeing some gains here. Not much movement with TSMC here, so you are seeing kind of a mixed bag across some of these chip makers here, just given the different narratives that we're hearing from Alphabet as well as AMD. SK Hynix, though, is still doing decently well, 1.5%. Great story on the Bloomberg about Samsung and the amount of market cap it's lost since, it hasn't been able to deliver when it comes to AI. It still trails behind the likes of SK Hynix here right now. And the approach to the open is looking like this. David mentioned that Reuters report about that fiscal package and maybe what we could hear by the end of next week here, $1.4 trillion in that plan. BE has a take on it saying, it's nothing new, something that we probably expected from many that economists out there here. But futures are pointing slightly to the positive this morning. Dave.
Yeah, lots of threads to the market story today. We'll get to the China a bit in just a moment there. But yeah, certainly details. The devil will be in the details as far as this is concerned. Let's bring in Adrian Zuercher, co-head of Global Asset Allocation at UBS Global Wealth Management, here with us in our studios to kick off this hump day session a couple of minutes away. You guys went overweight U.S. equities across your portfolios. Tell us why.
As you mentioned, actually the world looks very complex. You have election, data coming in, inflation, rates are going up. That doesn't really speak for high equity markets. But if you take a step back, I think in general we actually do see that the macroeconomic environment is very solid. So there was talk about soft landing or hard landing. We think actually we're in a no landing scenario where growth stays actually quite supported. Inflation is still coming off, maybe a bit slower than expected. The labor market is still solid. So that really points to solid earnings growth. We do expect double digits for this year, still very high single digits for next year. The market still looks attractive. We actually do think there's so much cash on the sideline that wants to go back to the market. They have missed the rally in the equity market. And we actually want to be positioned before the election because usually election brings a lot of uncertainties. But once the uncertainty is gone, it doesn't matter so much who actually gets elected. We actually do think that the market had sort of a relief rally as well. We get to the end of the year. So a lot of positive supporting factors.
There is that narrative, though, that if either candidate wins, you're going to see fiscal deficits. Rates are probably going to stay still elevated at some point. The Fed's going to be a bit restricted in how much they're going to cut. Does that impact your view on equities at all, though?
Well, two things on the election side. So we think it's very split at the moment, 50-50 who could win. But we have a quite strong view that if Kamala Harris wins, that it will be sort of a mixed government with a basically red Senate. While if Trump wins, it will be sort of a red sweep. So these are our key scenarios. And I think both of these scenarios should be actually positive for equities. Yes, the Fed might have to consider how much they can cut. We still have penciled in 50 basis points for the end of this year and 100 basis points for next year. Maybe they will skip one basis or one cut, but it will be based on strong numbers, and therefore I think the market will look through that. Eventually, rates are still heading lower. It's not that the Fed will start to talk about hiking interest rates.
Yeah, and as you point out, right, a lot of money still parked in money market assets. The 150 basis points of cuts, though, doesn't sound like a no-landing scenario. Why do we suspect the Fed still is able to cut rates in a no-landing scenario, I guess is the question there. And why do equities do well in the absence of perhaps more easing coming out of the Fed?
Well, should not forget that the Fed had to over-tighten. They lost control of inflation. They over-tightened. We went above 5%. Neutral rate is probably somewhere around 3.5, and that's where they will have to guide it to. So just to keep monetary policy stable and neutral, and it's not an easing mode actually they are going into, so they're basically readjusting to the market environment. And I said at the end, it all points down to earnings growth. Corporates are not earning real GDP growth. They actually are more in the nominal GDP world, and nominal GDP growth is declining, but it actually still remains very robust to what we have seen the last 10 years. So there's a lot of aspects. We have structural drivers as AI. Yes, the market will look a bit more into the earnings. Do they really deliver? And we can see it's actually also taking clear views. So if you are able to beat, you get rewarded. If not, you actually get also question, and basically market can trade lower. But it's still a two-way trade. It's not that you're surprising and nothing happens and you basically surprising negatively and the market is selling off. And I think so it still shows healthy environment.
It seems like you're leaning more towards the equity side of things. What about when it comes to fixed income? Do you think this market is cheap enough now that you can actually add some duration in your portfolio?
So we actually started to add a bit. We were long the whole year. We actually cut basically our long duration positions roughly 2-3 weeks before the first cut. And now we have seen rates backing up. We didn't expect that in this extent, but it definitely looks very interesting. You might want to wait for next week to see what's happening after the election, but it definitely starts to look like an interesting trade again.
Yeah, well, that takes us into income strategies, right? So what would be the preferred income strategies at this point in time? Is it in the equity market? Is it in fixed income, for example?
It's probably a mix. So we still like dividend stocks. And I also have to say that we talk about Magnificent Seven. So last year, these were the companies that really had earnings growth. The rest, the 493 in average, didn't have any earnings growth. It starts to be more balanced. So we see that the 493 stocks, particularly the fourth quarter, will catch up a lot with the Magnificent Seven. Their earnings growth is coming off. So we think there will be a broadening. Dividend stocks definitely look very interesting. But I would definitely go into the fixed income market as well. Definitely more interesting than cash. So we actually have maxed out our cash position to the lowest level in our portfolios.
Oh, okay.
But within fixed income, really still focus on quality. Valuation and high yield is really unattractive, and therefore be cautious there.
How much does gold come up in your conversations?
Hedge.
A lot.
Does it come up? Okay.
Yeah,
it does?
comes up a lot.
You have to push back?
The question is, I'm too late. Did I miss it? We have it in our portfolio. We went in. We cut our position by half. Probably also a bit too early, but we still let it run. I have to say it's a bit frothy at this level. We still see upside fundamentally, but it was going up in very short period, maybe a bit too quick. There might be some profit taking here and there. But I would say fundamentally there's still upside. You have central banks that are trying to diversify their FX reserves. You haven't seen very strong ETF flows, which we actually do expect will come in. we still expect the Fed to cut interest rates, and we still have a weaker dollar view, which should be supportive for stronger gold prices.
So what is the best election hedge then? Is it gold? Is it yen? Given how cheap it is these days, I mean, what do you look at something that, I know you're saying you can see through the noise and still lean to U.S. equities, but how are you actually protecting your portfolio as well?
Very good point. I mean, we try to build very robust portfolios. So we have two key election hedges. One is actually, despite we're overweight equities, we have a few derivatives in it that sort of lower our downside. The other key election hedge we have is just short CNY versus US dollar. We actually do think the CNY could suffer further going into particular Trump presidency, and therefore I think that's a very interesting hedge, because you're getting paid in US dollar interest, you're basically paying CNY interest, so you actually have a nice carry on top of that if it doesn't.
We'll talk more about China, I think, in the next segment, but I just want to get your thoughts on, is there still a cyclical trade to be made here, a tactical trade to be made in China? Do I need to wait for the elections? What's your overall view on that before we unpack that?
Probably still some tactical upside, but I will probably wait for the election outcome. And we also see it has died down a little bit. So everybody wants to know who they will face going forward, and then it could be actually a good, still tactical trade at least.
All right, Adrian, sit tight. We'll have more from Adrian Zuercher there, co-head of global asset allocation at UBS Global Wealth Management. Still ahead, we're going to dig into Beijing's Made in China 2025 master plan and which of its tech and manufacturing sectors are now leading or still lagging against its global rivals. We have a deep dive on that with Bloomberg Intelligence this morning. But first, Beijing is reportedly considering more than $1.4 trillion in additional fiscal stimulus. We have details coming up, according to those reports. We're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is the China Show. Futures are flat this morning.
Tuesday, election night is here. Trust Bloomberg for up-to-the-minute results as the races for the White House and Congress are decided, as well as detailed analysis of what it all means for the economy, markets, geopolitics, and more. Tune in at 5 p.m. Eastern for an extended Balance of Power leading into full team coverage at 7 live from the Battleground States and Harris and Trump HQ. It's election night on Bloomberg. Context changes everything.
Welcome back. 15 minutes to the opening bell, and this parade of earnings is the other big story we're tracking apart, obviously, from all the flows ahead of the U.S. elections, right? So I think today more than $3 trillion of market cap, and that's simply on MSCI China. A set of reports. So you have some of the biggest car makers, if not the biggest car makers. You have the biggest banks. Stanchart, by the way, also reports today as well. Some of the biggest property developers like Vanke reports. You have some of the consumer plays. Midea, Haitong, CICC, basically take your pick, this nice cross-section across industry to give us maybe, and we'll see what sort of guidance looks like amidst this policy pivot that not just consumers and markets are digesting, but also corporates and what they do with that information as they plan ahead, looking at 2025.
Yep, and we're looking at next week, really, and what this NPC Standing Committee is going to look like, of course, from 4th to 8th, but we might not get any details until the end of the week. Maybe even after this U.S. election, right? I take a look at what we've been hearing from the likes of Reuters, though, that China is reportedly considering more than $1.4 trillion in additional borrowing in the coming years to shore up the economy and address local governments' debt risks. Let's bring in our China correspondent, Min Lo, to give us the breakdown of this fiscal package and what we're hearing so far.
Yeah, so $1.4 trillion is about 10 trillion yuan in a fiscal package that is about 6 trillion yuan in special sovereign bonds to tackle local government debt. This is in line with what Tyson had previously reported. And then another 4 trillion yuan in local government special bonds to help these local governments buy up idle land and property. And on top of that, there will be another at least 1 trillion yuan in other measures, including measures to boost consumption, plus another 1 trillion yuan to recapitalize the banks. So overall, that headline number is at the higher end of estimates. But of course, then, questions around the time horizon of these bond issuance and how those funds will be used, whether it will be front-loaded, all of that will matter as well. And also, if Trump wins the election, sources are saying, according to Reuters, that the size of that stimulus could be higher.
Yeah, so a lot of moving parts there, a lot of ifs. What's been reaction so far to just maybe the overall number?
Yeah, well, if you speak to David Chi, we know he's very hard to impress. Our Bloomberg economics colleague is saying that it is really still far from enough, because if you look at the direct consumption stimulus up to $1 trillion, that's still quite modest, raising some concerns about whether it's enough to fight those deflationary risks. And if you look at the property measures, $4 trillion, that's going to be spread out over 3 years, over 5 years. So it's 800 billion yuan a year. That's estimated to clear up about 1.4% of the unsold housing inventory of the market a year. So the pace is going to be quite slow. I think Christy Hung also had a note saying that it's really far from enough to turn around the housing market. And for the local government debt, 6 trillion yuan is also far from enough. If you look at the size of the off-balance sheet debt, that's estimated to be about 50 trillion yuan. But of course, overall, it's still a step in the right direction, although markets are looking really hard to please these days.
Yeah, given that we've come up, of course, a lot too. All right, Min Min, thank you so much. Min Min Lo there, our China correspondent, and what to expect November 4 to 8 is that meeting, of course, in China, which is interesting because right smack in the middle of that is the U.S. election. Still with us here on set, Adrian Zuercher, co-head of global asset allocation at UBS Global Wealth Management. So you mentioned any potential tactical rally in China might have to wait until the U.S. elections are over. Do you think, to Min Min's point, that Chinese policymakers will also need to wait who wins before they give us the goods?
I think they want to wait. I mean, the package and the rumors we have heard is probably in line with what we also would expect. Yeah. And I'm pretty sure the dates that has been set was related to the U.S. election. They want to see how markets react, who they will face as a president. Then they will announce basically the stimulus package as well and probably readjust that. And I said that's probably where you have potential for a good sort of short-term trade. If it's structured enough, we will see. I think the key issue in China currently is still you can throw a lot at this economy. And as I said, the market is cheap. People in opposition, that's probably driving some flows. But it's the real estate market. And as long as you have real estate prices going down, it's very hard to convince the consumer and creating this positive feedback loop for the consumer to get back and spend. And I think that's, if you look at the economy, which is missing. And I think that's the biggest part where I'm still concerned about the structural challenges that China has.
So do you think it's still more going to be domestically driven, or do you think I look at what tariff risks, for example, is that going to be a bigger overhang on this market?
Well, if Trump gets elected and he follows up on his 60% tariffs or whatever it is, that's definitely a major challenge that will impact GDP growth, definitely also impact consumer spending. Yeah. And so it's definitely much more domestically focused. And I think that's what they also have to do. The good thing is in China, it's a very big economy, so they have the flexibility also to engineer a domestic-driven rebound. But as I said, you have to basically stimulate the property market, which structure is probably not what you want to do, to get sort of this positive feedback loop for the consumer.
And, since if it is indeed the property market that will be, the ultimate acid test of, any potential bull market, that might be at least still a year away. How do you think, what is the appropriate exposure you think to Chinese equities or Chinese assets at that you think people should have while we wait for that ship to eventually turn, hopefully?
So what we try to focus mainly is really building solid global portfolios. And unfortunately, China is a relatively small part out of that. We're talking about maybe 2% exposure. If you want to have a bit more of Asian focus for
2% exposure?
Yeah. If you want to have a bit more of an Asian focus for some of the clients who want to have a bit of a home buyers, we still talk about 6 to 7% exposure to China.
Wow, that's not a lot.
But we also should not forget, the composition also has changed. So India actually caught up with China largely. You have Taiwan, you have Korea. I think if you take India, Korea, and Taiwan together, it's almost 45% of the Asian ex-Japan market. So you see Asia overall is growing. There's actually positive trends. And so you have a much more balanced portfolio if you invest into Asia than just basically be overly dependent on China.
I was going to get your take. What is the playbook for this election? Can we do what we did back in 2016 when Trump won? At that time, inflation was way more controlled. Rates were much lower. there was this rally that went on for about 15 months after Trump won. I mean, can we subscribe those same sort of narratives this time around? Because we've already seen equity markets rally so much, and things are not cheap anymore.
That's a very good question. I think the environment is very different. So we are much more advanced in the cycle. Well, the positive news is the Fed is cutting, interest rates are coming off. There will be more stimulus. I think the market, at least initially, will play sort of the playbook of 2016.
Okay.
But then once we actually go into next year and we start to see policies coming through, then we will have to see how solid the macroeconomic environment is, how much the economy can digest. If it's overspent, how much it will influence inflation.
Yeah.
Should not forget, in 2016, there was no inflation. They wanted to create inflation. Now we are sort of in a probably good environment and it's coming off. But if we're pushing too hard, inflation might go up and that will be something negative for the markets as well. So I think the market will play it until the end of the year, until the inauguration, the same way. But then afterwards might be a bit more nuanced on that part.
Fancy a guess. If Harris takes it this time next week, what do you think market reaction will be the first 48 hours? And if it's Trump, what do you think market reaction will be?
It's not what we usually do.
Yeah,
but I give you my indication is that I still think markets will be positive because the uncertainty is away. We get more clarity. And I said it will be probably a red Senate, which also should dampen some of the policies that she wants to implement.
Adrian, great to have you. Adrian Zuercher there, co-head of Global Asset Allocation at UBS Global Wealth Management. And by the way, we like to hear from all of our viewers as well. So we put together a short online survey. So you see down there, I think it's going to pop up, that QR code. Get your phone out right now. You can start scanning it and tell us what you'd like to see more on Bloomberg Television. And from me and David, too, on The China Show. We welcome any sort of feedback, suggestions.
Constructive, please.
Constructive as well. All right. Free market looking like this here right now. Hang Seng is down about 0.5%. And we're taking a look at what comes to futures still in negative territory this morning. This is The China Show.
Welcome back. You're watching The China Show. Good morning. Just a couple of minutes to the opening bell. And as you can see, the approach to the open, the hump day session is lower. We'll get to all the earnings coming through a bit later on.
Yep. Analyst actions to tell you about Qingdao Brewery. A shares cut to a hold at BOC. The big one is Xiaomi. Citigroup raising that price target by 35%. They're talking about the flagship Mi 15 smartphone with AI features. Also, that EV model that targets the high-end sport car segment around that upgrade. The open is next. This is Bloomberg. Welcome back. You're watching The China Show. We're counting down the open of markets, and so far it looks pretty just, I guess, slow here. We're Hang Seng, we're now about 0.5%. Futures are pointing lower this morning. It's a slightly weaker renminbi, but we are exactly 1 week away from this U.S. election, so certainly there's still a lot at stake here the next couple of days or so. And we got a lot of earnings. An avalanche, Dave, they're calling it.
Yeah. The extravaganza, bonanza, we settled on avalanche, right? 1.4 trillion, well, a couple of numbers, right? 1.4 trillion is the fiscal stimulus reported by Reuters. 3.4 trillion is the amount of market cap that is set to report, at least on MSCI China alone. And that's not to mention all the companies that had already reported as we look at earnings reaction in the opening minutes, as you look at these opening numbers here, 0.5% to the downside. So Multi reported last week. I think it's one of its peers, Wu Liangye, is set to report, I believe, today, 1.2% to the downside. As you can see, a lot of the big banks, the big car makers. There's also several other sector themes to watch today, of course, on the back of gold rising to a record, and Bitcoin is very close to its own record as well. More on that in a moment. Hong Kong and the open there as well. And speaking of earnings, HSBC was out during lunch in the Hong Kong session yesterday. Coming out today will be Stand Chart. Watch out for that. HSBC still seeing some upside, as you can see, although there we go. Alibaba, AIA, and Meituan, and some of the other big names coming out as well, at least in the opening minutes here. Okay, let's change things up, please. And so we talked about gold, right? So this time in the next hour, we'll be having a more in-depth conversation with around gold with State Street Global Advisors. The chief gold strategist, George Milling-Stanley, joins us to really unpack where the incremental buyers are coming from and really what that incremental demand is looking like right now, given that 2,800 looks to be just around the corner on spot. As you can see, some upside coming through. Some of the crypto-related stocks, not really so much. Meitu's up 2%. Bitcoin should be coming up on your screen. Thank you so much. Also very close to its own record. All right, these are companies that reported yesterday, and the next page will show you the companies that are set to report today. And this is really just a very short list of that earnings parade. BYD, I don't know how to pronounce it still. Is it Vanco, Vanke, Wanko? And ICBC Semi Heavy, of course, set to report later today.
Yep, as we said, right, $3 trillion in market cap. So it is a busy day for earnings in China. So far, I think there's this. The overall consensus is that it's not quite as robust to really continue this rally, and that maybe we do need some more signs of stimulus in this MPC Standing Committee to at least reinvigorate those animal spirits once again. But yes, we've talked about BYD. China's biggest banks are among those that are reporting today as well. So you're getting a flavor of a little bit of everything. Let's get a preview from our transport reporter, Danny Lee, also Charlotte Yang, our Asia equities reporter. Danny, I'll start with you. When it comes to BYD, what kind of figures, milestones are we looking at in this set of results?
So we're looking at the first time BYD has overtaken Tesla in revenue this time. Previously, we were looking at vehicle sales. Now, this time, it's revenue. BYD could land in around $28.7 billion for this third quarter. That would be far better than what Tesla earned, which was $25.1 billion. And so it's a nice bit of a milestone because Elon Musk last week on his earnings call was talking about how Tesla was the only profitable EV company on the road right now. Not so much the case when you factor in BYD, all of it, what it's done over the years, and so they're looking at about 1.5 billion in US profit as well. So not too bad going for what was a record quarter.
Yeah, and I think the markets have been extremely bullish in BYD. I think we have a graphic that shows us this. Are these estimates just about right? I mean, has the bar been raised to a little bit too high for this Chinese brand?
I don't think so, because when we look at the previous quarter, its revenue came in around $24 billion US. So the fact that it sold more cars than ever before this quarter, and the discounting that they've had to put into wasn't too bad compared to earlier in the year. Not too bad. I think it's a pretty fair assessment of where things could go. Even if it undershoots slightly or even beats, who knows? We'll be waiting.
And this, against what we heard just overnight, Europe finally formally imposing higher tariffs on Chinese EV imports. We got a bit of the response from the China side here this morning, but what happens from here, Danny?
Yeah, I think when you look at just reading the tea leaves of the China response, clearly they are not looking to retaliate right now. Although the threat of putting more tariffs from the China side on European imports, particularly on premium vehicles, is a risk there. But they are looking for more talks. And so this is what they committed to. Despite the tariffs coming in, they would be looking for more talks. And we'll just have to see how quickly they can get their heads together on this.
Okay, let's talk about the banking side here, because earnings are coming out as well, the big ones. I think we're up 25% as a group. What do the earnings mean then for this rally?
Yeah, so I think unlike the optimism people have for the EV sector, I think for the banking sector, it's more likely to be a reality test for this, this corner of the market that has been really winning this year to date because of they're seen as more defensive, they offer higher dividends. But now investors focus on the profitability, where there have been some concerns, how their profitability for these banks will fare given that, the nation's weaker credit demand as well as reduced lending rates. And also their valuations have come up, this year after the recent rally.
I mean, there's the earnings headwinds, the NIM compressions, given that we've seen rates being cut across the board, it seems, in China right now. But so what remains some of the key selling points for these banking stocks? Is it just the dividends?
I think the key selling point will remain to be the dividend because so the estimates, so for the banking sector, likely to offer 5.2% for next year, and that's still more than doubling the yield you get for 10-year government bond, and also higher than the CSI 300 average, which is about I think less than half of that. So I think dividends is still going to be a big selling point, especially if you think about the volatility that could come up with the election. So people still want to be some safer bets.
Yeah, there we go. Year to date, CSI 300 Banks Index up 28%, and that massive spike recently has really also, I guess in some way, depressed the dividend yield. Thank you so much, team. Danny Lee and Charlotte Yang there on this earnings parade that's about to hit this market over the next couple of hours or so. Right, coming up, how the U.S. is struggling to stop China's push for tech supremacy. We look at the progress so far in Beijing's signature industrial master plan, Made in China 2025. That's next. This is Bloomberg.
Donald Trump has spent a decade trying to keep the American people divided and afraid of each other. That is who he is. But America, I am here tonight to say that is not who we are.
Kamala Harris, they're presenting what her campaign is calling its closing arguments at the National Mall over in Washington. Meanwhile, Republican Donald Trump is in the, critical battleground state, of course, of Pennsylvania, and our news desk editor, Jill Deeses, is here with us watching both candidates. They've been speaking in the last few hours or so. Why don't we start with Kamala Harris, and, let's expound further on what you mentioned there.
Yeah, really, I think what we're seeing out of Kamala Harris right now is this attempt to thread the needle and really kind of fine-tune her message here, which is quite broad. She's trying to cover everything from, sort of denouncing Donald Trump as she's called him a fascist, a threat to democracy. I mean, just, even down to holding her rally right on the site where Donald Trump held his rally on January 6th in 2021. Yeah. So we're seeing that in part of her message, but then we're also seeing her trying to tie that together with her economic policies and her messages around there, which has been really difficult for her to thread over the course of this campaign, given how high inflation has been, kind of this muddled attempt to marry her message as this new candidate for the White House, despite the fact that she's obviously currently in the administration. So you're seeing her kind of try to broaden all of that out, really tie that to this idea of freedom being this umbrella term covering all of these different policies and, those threats she sees as posed by Donald Trump. So it's a really interesting combination there as she tries to kind of, bring that together and sell that as her argument.
And Trump's in Pennsylvania after, of course, being in New York and in the Madison Square Garden rally, which has garnered a lot of attention, obviously. But what is his closing argument?
Well, so for Trump, I mean, first of all, he's trying to move past some of those the disparaging comments about Puerto Rico that one of his speakers said at that Madison Square Garden rally. He's really kind of pivoted more in this counter-programming effort in Pennsylvania to talking about the border. That's really, of course, his strongest issue as the Republican candidate against the Democrats. So that's kind of something that he's been, really kind of hammering home here. But again, I think that these types of rallies just kind of show you, and the spread that we've really had over these candidates over the past few days has really showed you how unusual this campaign has really become. I mean, again, hosting a rally when you're the Republican presidential candidate in Madison Square Garden in New York City is quite
not a swing state.
Exactly, not remotely a swing state. And so the fact that you're seeing that kind of thing, I mean, it does kind of show. I mean, these candidates still have plenty of events coming up over the next few days. As we get closer to Tuesday, we'll have to see how everything unfolds there.
Yeah, I was about to say we're exactly a week away. I mean, this time next week, right? Everyone will be glued into as the results start to come through. I mean, okay, so we're looking at, the closing arguments. To your point, we have a few more events to look ahead to in the next few days or so. Anything specific you think we should be attuned to?
I mean, at this point, I think it's really just looking out for whether there's anything that's going to move the needle or sort of shock in a big way. Again, like looking back to that Madison Square Garden rally, obviously that garnered a lot of attention. I mean, when you've got all of these speakers, including the candidates themselves on stage, you're really just looking for any sort of fumble or anything like that that might move the needle here. But again, I mean, while the election is Tuesday, many Americans have already been voting. I mean, we've had a lot of voting that's already taken place. So we'll just have to see whether there's anything there that actually tips them, in one direction or the other as we get closer.
Jill, thank you. Jill Deasis there, Bloomberg News desk editor, as we count down to this U.S. election just 1 week away. I look at some other top global headlines this morning. Australia is set to invest $14 billion over a decade to ramp up domestic missile and munitions manufacturing. Officials are expected to announce the program on Wednesday to produce such weapons, quote, at scale. Now, the move comes as the current government looks to develop long-range strike capabilities in the face of a regional arms race. President Biden says Ukraine should strike North Korean troops if they enter the country to fight alongside Russia. U.S. officials believe Pyongyang has deployed 10,000 troops, with several thousand moving towards Russia's Kursk region, where Ukrainian forces are fighting Russians. Biden was also asked by reporters if he was concerned about reports of North Korean troops already inside Russia.
I'm concerned about it, yes.
Should the Ukrainians strike back?
They cross into Ukraine, yes.
Hezbollah says Naim Qassem will become its new leader after long-standing chief Hassan Nasrallah was assassinated about a month ago. The Lebanon-based militant group's main decision-making body announced the move online. Qassem has been deputy leader since 1991 and wasn't seen as the obvious successor.
Let's stay in politics, but let's pivot back to the U.S. elections here. So relations with China remain and will remain for the foreseeable future a key focus, really, as we move past the elections and into, of course, the next few years or so. As you can see, of course, the big take today and the title, the U.S. efforts to contain China's push for tech supremacy are faltering. And export controls, you have financial sanctions among some of the different measures and methods that the U.S. has imposed. Now, a Bloomberg investigation has actually found that China is still positioned to dominate the industries of the future, and much of that is because of the industrial policy blueprint named or known as Made in China 2025. This new report by Bloomberg Intelligence and Bloomberg Economics looks into this master plan specifically, where China has made progress so far and where it also is lagging. Let's bring in Francis Chan, our Bloomberg Intelligence senior analyst and one of the lead authors of this report, to talk us through. Let's start with a big picture.
Sure.
Where has the U.S. failed?
Well, in fact, this initiative, the main China 2025 initiative, was first revealed in 2015. And over the past 9 years, obviously, a lot happened with the Western countries being a bit alarmed of China's technological development, which triggered, first of all, in the previous Trump administration, with more tariffs, then followed by Biden's administrations with export restrictions on some high technology items. And what the U.S. has been fitting in the picture is, of course, trying to contain some of the advancement by China. But at the same time, China has achieved some of its goals, according to our analysis, Bloomberg Economics and Bloomberg Intelligence. Spreading across 10 strategic sectors, we identified 13 key technologies of competition. And China has gained a really global leadership in 5 of them. They are trying to catch up and stay competitive with global peers in another 7. And only in one of the technology is obviously behind the global standard.
So you're seeing that here right now, of the 13, right? So the likes of unmanned aerial vehicles, solar panels, EV certainly is the big topic here as well. What does that tell you about U.S. sanctions? I mean, and really how effective they have been? Is it just merely slowing this development versus actually stymieing it?
Well, I think at the very least, for the export controls on advanced nodes, semiconductors, the key equipments, design, and artificial intelligence, that would definitely slow the development of China. China is still trying hard to catch up, and they will find ways to. But at the same time, if you look at some of the more mature items, like the mature nodes, semiconductors, China's production is still pretty significant in the global market.
So I'm curious, so we have 13 key technologies, and as you point out, China is the global leader in 5, 7
catching up,
or they're nearly there, but just maybe behind the leader. How do we make this assessment? How does your team make this assessment of whether or not China's in pole position or very close to becoming pole position over the next few years?
Well, I think it has been a really dynamic exercise Bloomberg Intelligence and Bloomberg Economics has conducted. We tried to evaluate, first of all, what the initial targets set in 2015, whether within those basket of technologies targets have been achieved. Then trying to do a across-the-board analysis comparing what Chinese manufacturers or firms have achieved so far, what they are stacking against the global peers at the current stage, and finally the forward-looking view by 2030. That's what we did.
How are you looking at this election and how this could change maybe the trajectory of some of these industries? Do you see, if Trump does impose those 60% tariffs, what impact that could have?
Well, obviously, we are still waiting and trying to see who will really be the new host of the White House. And obviously, really change the path of China's technological development. If we do have a Harris or another Democratic presidency, obviously we expect the status quo or the existing restrictions, while Donald Trump could be more a wild card, as promised 60% tariffs on all Chinese products, and you may expect even more ban on the technological products export from the country. But all in all, we are still waiting for other milestones other than just the U.S. election. There will be the FOMC meeting 2-3 days after the election to determine the global interest rates prospects in 2025. It affects China's central bank's capacity to maneuver to revive its economy. Towards the end of the year, the nation will have the Central Economic Working Conference, which will set priorities for the whole country's economic development in 2025, and we may see more of the new policies supporting these technologies. And finally, next year in March, there will be the China's National People's Congress, perhaps shedding some light of the new 5-year plan starting 2026.
Yeah, I think you make a very good point that a lot of the development and progress so far from 2015 has really been because of what they've been able to do domestically. You bring in the cyclical part to the story, and I'm wondering whether the weakness in the economy or their efforts to revive the economy through fiscal stimulus, do you think that is taking away from their ability to focus on these longer-term goals? In other words, can we draw a direct line between the weakness in the economy and how they're able to pursue, silently almost, these longer-term technological objectives?
Well, I don't think the efforts towards those targets or goals are contradictory. In fact, we see more monetary policy support to the stock market being reviewed since late September. And in terms of technological development, we have been seeing it as long-term plans, long-term goals by the Chinese government. We do see the concurring investment from state-owned funds. We see the maybe cheap credits from state banks, government procurement projects for those key technological advanced companies. So there's no really contradiction or conflict between reviving the economy versus to make advancement in technologies.
Yeah, this is a very comprehensive piece. How long is it?
Many pages.
You know how many words? Many pages, right?
48 pages.
48 pages. Fantastic. Too short of 50.
Oh, yeah.
Okay.
Easy read during the weekend.
Okay. Francis Chan, fantastic work.
Thank you.
To Bloomberg Intelligence and Bloomberg Economics, joint effort here. We'll have more on this report in the next hour. By the way, we'd like to hear from all of you, and while we do this, I'd like to invite everyone to whip out their smartphones and do scan the QR code you see bottom of your screen. In fact, I'm going to do it while I read the teleprompter and see.
Yeah, now, some said it was too small.
If it is too small,
you
can
keep it on
give
there longer. At least maybe we'll see if it works.
Let me try it now. Now, if it is too small, you can give us your feedback on the survey itself. That's of course it is a little bit. At least I'm sitting a bit far away. Oh. No, actually, I was able to do it.
Okay.
So I can give my commentary on how the shows have been so far. Please, of course, chime in. Be nice, be fair, but be firm, as they say. for our Bloomberg clients and, of course, for Bloomberg viewers. All right, there we go. CSI 300 intraday. We're off by a quarter of 1%. Plenty more ahead. This is Bloomberg. Right, for a look at markets, about 23 minutes into the session here. So we're looking at chips, TSMC, Foxconn Tech, of course. Some of the companies, listed in Taiwan and elsewhere as well. On the back really of some of the earnings coming through as well. We'll talk more about this later on. Chalco, speaking of earnings here, so among the hundreds of Chinese companies that have reported so far, one of the more pronounced reactions has really been in shares of the Aluminium Corporation or Aluminium Corporation of China, depending on which part of the Atlantic you're from. 9% down. We were down as much as 13% at one point. It was an earnings miss, and as you can see, markets are reacting quite in line with reality here. As far as other parts of this equity market story go, it's really been an extremely quiet week. Amidst all the earnings coming through, amidst this melt-up in yields. And, of course, this time next week, of course, you have the big event in the U.S. elections. And we're lower by 1/10 of 1%. And among the other things that we're tracking here, so we did get an initial reaction in some of the commodity markets in reaction to the Reuters report of this big number, this fiscal stimulus that they might announce, maybe after the meeting next week.
1.4 trillion is the number. But yeah, certainly you take a look at the breakdown of that. Is it going to be enough? That's still the key question here. And of course, it's not just a domestic issue anymore. I think more and more economists are saying that policymakers might be waiting for this U.S. election to determine that number and what it could be by the end of the week. We got plenty more coming up. Going to digest some of the tech earnings of the U.S. there with S&P Global, Visible, Alpha, and more on gold, too. This is Bloomberg. Welcome back to the China Show. Here's a look at the CSI 300 half-hour into session, and really not much to tell you about. We're seeing a little bit of downside, about 1/10 of 1%. Offshore may be a little bit worse, but really we're talking about just very, very marginal losses here this morning. And it really just comes down to, we're just seeing this kind of calm before all this event risk storm that's about to come at us. Yeah. Starting Friday
with a jobs report.
Yeah.
And then election. So hopefully it's more garlic and butter on a well-heated pan more than burned butter for markets. Don't know where that's coming. Don't know where that's coming from as well. 0.5 of 1% to the downside there on MSCI China. By the way, in case you guys missed that QR code earlier on, you can zoom back on TV Go. The reason I say that is you can give your comments in to our viewers for on shows. The macro story has really been this approach to the U.S. elections, right? To Yvonne's point, there's a lot of event risk on the table this time next week, U.S. elections. This melt-up in yields, can the Fed still cut as much? And also, when you look at the 10-year and the steepening in the curve that's happened recently, is the U.S. economy actually a much better footing? And the plus, are the markets also discounting possibly further fiscal stimulus down the road, and this melt-up in yields could continue? The gold trade continues. That's a record high on gold spot, and Bitcoin is very close to its own record as well. We'll be having an in-depth conversation on gold in about 30 minutes from now. Now, let's back up a little bit right now and have a look at where we are as we wrap up October. We haven't even talked about Halloween. Going into the last day of October, we are on track for the worst month for U.S. Treasuries, looking at the Bloomberg gauge, going back almost 2 years from now. So yes, this pivot and this retracement in yields higher has really been quite substantial of late.
Yeah, I think Yardini, he's the guy that, of course, coined the whole bond vigilantes sort of term. He's starting to see signs of that coming back in some ways as we get closer to this election. And I think he was saying, 5% for yields is something that is actually looking pretty reasonable versus maybe a few weeks ago.
And who'd imagine that, right? When we took out 4% on the way down as the Fed looked to deliver 50 and then another 50.
And then yields pick up, which is very counterintuitive.
Yeah, this dance, as they say, right? In markets between how big the Fed can and cut. Well, that goes into perhaps why this equity market seems to be stuck in a very tight range. I mean, separately, of course, where you are with the U.S. markets, and as you can see, S&P futures are picking up quite a bit. This might have to do with the fact that some of the earnings coming through post the market close. In fact, let's get more on that story because we're also watching shares of these Asian chip and AI stocks after AMD gave its disappointing forecast, and markets seem to be moving in the opposite direction, but maybe there's more than meets
Maybe
the
it's
eye.
the Alphabet story that's helping things too.
That's probably that too.
Yeah, let's get to our tech reporter, Annabelle Jewelers. Let's focus on AMD first, maybe the bad news out of the way. Why was this so concerning to the market, you think?
Well, I guess both of them have the AI theme, and it's sort of about who's doing better in this space. And of course, when it comes to the chip side or the hardware side, AMD is in very tough competition with NVIDIA, and actually probably NVIDIA wouldn't have that same sort of pressure because they dominate the space so much more. But AMD is continually trying to play catch up here. They gave an outlook for the fourth quarter and it disappointed investors. But investors, of course, have very high expectations around what AI companies can achieve. So their expectation from an analyst perspective would see 7.55 billion for the fourth quarter in terms of revenue. They said 7.5. So it's an undershoot. It's not a huge drop, but still it was enough to send that share price dropping and after hours trade there down 7.6%. The company actually had a better than expected third quarter. Sales or revenue came in better than expected, and still they're seeing $5 billion in sales from their AI accelerators this year. That's hardware that essentially trains the AI tools and applications faster than a traditional chip in this space or accelerator, but they still are playing catch up to NVIDIA in the space. And as I said, when you take a look at their revenue from last year, this year, the full year projection, they're really just dwarfed.
Alphabet earnings. Tell us about them.
Well, Alphabet, it really benefited from that spending on cloud because, of course, a lot of companies are racing to try and develop or train their AI applications. And so companies like Microsoft, Amazon, and then also Alphabet really dominate in this space. The pie is just getting bigger. That's what analysts would tell you. It's not about trying to compete for a set amount of market share. The market share or that market is growing, and so their slice of it can continue to gain as well. In terms of the actual figures that came out, revenue came in at 74.6 billion. You can see better than the 73 billion projected, but when you take a look at the breakdown there, cloud came in better than expected, subscriptions, platforms, devices, advertising, all of these numbers beating at the top line level. In terms of what else we heard on the earnings call here, it was really about that desire to cut down spending in terms of AI applications, and the company said actually our AI tool is getting cheaper to run, and one of the ways they're looking at doing that, of course, as well comes down to their spending around energy. We know that energy prices and energy demands from AI are becoming a real talking point here because you just don't have that computing power, that energy available, but actually Google is one of the companies, or Alphabet, that's looking at investing in things like nuclear power.
Well, thank you, Annabelle Jewelers there, a Bloomberg tech reporter, just breaking down those U.S. tech earnings for us. Joining us now is Melissa Otto, head of TMT research at S&P Global Visible Alpha. Melissa, it's always great to have you during earnings week. And I got to get your take. Maybe I'll start with Alphabet. Just given this is a company that's been kind of trailing behind when it comes to the Mag 7. Do you think this was really a surprise beat to the upside, or do you think the bar was just low for them to actually clear the quarter?
You know, it was a solid quarter. They beat both on the top line and the bottom line, Visible Alpha consensus. I think, the big surprise to the upside was really around the Google Cloud margin. Just to put this into perspective, Visible Alpha consensus was expecting 10.4% margin, and the company delivered 17%. So a significant beat there. So I think, as we look out to next quarter and next year, if that margin remains around that 17% level, it does suggest the analyst estimates are likely going to have to come up for next quarter and for next fiscal year.
What are the risks, Melissa, to your point there? What are the risks to this margin story here?
It's hard to say exactly. I mean, the management team was asked about that on the call. And they said, okay, we're scaling the business, we're seeing better efficiencies, we're seeing strong demand, but at the same time, we're also seeing headwinds from costs. and depreciation. So it'll be interesting to see how they manage that trade-off and what the right margin will be for that business and how the actual consensus number shakes out for next year. Right now, Visible Alpha consensus is expecting 13% margin. So if that 17% margin remains intact, there's about a 400 basis point potential upside there.
Okay, how do you look at some of the medium and maybe long-term risks out there? I mean, for one thing, there's the cost of antitrust regulations and actions potentially there. There's also this sort of worry that the market has that, its core business might be threatened by more of these AI players that could actually impact their whole search business in some ways. I mean, how do you deal with those sort of longer-term risks?
I mean, they're so nebulous at this time, and I think the AI story is just getting started. It's really hard to quantify that and think about what the actual impact to their valuation and what the fundamental impact will be. I mean, we're not really seeing that creep into their business at the moment. When I start to see that erode their margins or erode the search business, then I think I would start to get concerned.
Right. So at 22 times earnings, let's just call it even there. Do you think the stock is still fairly valued, or is there, I guess to your point, because the AI story is also quite new, do you think the chances are we'll get a re-rating to the upside more than the opposite direction, Melissa?
That's what the numbers are telling me.
Okay, fair. Why don't we talk about the other laggard here? Let's talk about Apple. I think it reports Thursday evening. Let me preface by saying this is going to sound more negative than it actually is. What's wrong with the Apple story in your view?
I mean, the Apple is at I think a crossroads at the moment. Their Apple Intelligence has been a bit underwhelming. It hasn't dazzled the market. I don't see consumers rushing out to upgrade their phones. This holiday season will be a critical time and a real test to the attractiveness of the Apple Intelligence offerings and whether or not the upgrade cycle could maybe get a bump this holiday season. But as for now, it's had a slow start.
What are you looking for in terms of maybe Q4 numbers, even just the outlook for 2025? What are some of the numbers that we need to see to actually have a positive catalyst on the stock?
Yeah, it's going to be a tricky one. I mean, I think I would like to really see some visibility in terms of that upgrade cycle. We've seen some volatility in the iPhone unit numbers into this quarter. Coming out of last quarter, the market was expecting 53 million units. That dropped down to 51 million units, $200 million in sales for iPhone. So I think, those right now are the numbers to meet or beat. So if they don't do that, if there is some sort of sluggishness around that, it could provide some additional volatility in the shares. And I think the company needs to come out and give some color around what we should expect for fiscal year 2025 and what that's going to look like, what the cadence is going to be.
Okay. The other one that's coming out is Meta. Among the many things we could obsess over when it comes to this company, what are the top two things that you think we should be paying attention to here?
Meta's been on a tear since their Meta Connect.
Absolutely, yeah.
They gave a pretty impressive presentation around Llama and their wearables, and I think what it made the investment community wonder, is Reality Labs going to finally start to turn a corner? Coming into this quarter, Visible Alpha consensus is expecting $4.7 billion in losses for that business. That's where the consensus is. So if that business starts to do a little bit better, I think that would be an interesting angle on the stock, because I think it's well understood that the family of apps drives the company, is the engine of earnings growth for the company. But that Reality Labs business, where they do a lot of investment, where they're more experimental, could this be a year where, or the next couple of quarters, could we start to see that business start to turn a corner? So I think, that's something that we're looking at very carefully.
The rest of the Mag 7, what are you looking forward to the most? I know earnings expectations have already, I think, pretty much halved for the third quarter. So I think expectations have at least been tempered down a bit. But what are going to be the ugly ducklings? What are going to be the standouts?
It's always interesting, that's for sure. There's never a dull moment in big tech. That I can certainly say that. I think Amazon is another interesting one worth watching. Their North America margin is going to be something that the market is going to be focused on. That margin has been jumping around as well. It was over 6% at the start of last quarter. It's now dropped down about 60 basis points on some of their investments, and so you wonder, as we come into the end of towards the end of the year, into the holiday season, what the margin is going to look like for the full year as well as for next year. So I think that's a business that could potentially see some interesting movement, whether it's their advertising business, whether it's consumer sentiment. We had incredibly positive consumer sentiment out of the U.S. today. So does that suggest that potentially consumer buying could be better this holiday season? I don't know, but that's certainly going to be something that I'll be keenly listening to see if the company makes any sort of commentary around that in the quarter.
Melissa, thank you for the time. And, I got to say, you really put the fun into TMT. As they say, find a job and find something that you love and enjoy. And I think you're probably one of the people that come to mind immediately when I think about who are the people that enjoy what they do. Melissa, thank you so much. Melissa Otto there. That's a compliment, by the way, in case it's not obvious. Head of TMT Research at S&P Global Visible Alpha. Still ahead on the China show. While Bloomberg Opinion thinks a possible Trump second term might muddy the waters over the size of China's fiscal stimulus. The details on that just ahead. This is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Worth getting out of bed this morning.
The employment outlook, it's been bullish. People are good.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
How dependable is this data?
People want to know the outcome of the U.S. presidential election before they start maybe moving jobs. And guess what? The Fed has to make a big decision based on this data.
The October Jobs Report, Friday on Bloomberg.
Well, China is reportedly considering over $1.4 trillion in additional borrowing in the coming years to shore up the economy and address local governments' debt risks. That report came through from Reuters. Let's get the take from Bloomberg Economics, our economist Eric Ju, and also Bloomberg Opinion columnist Shuli Ren joins us now. Eric, your take on this number so far?
Honestly, the first reaction I've read from the news, it's not like news, it's old news. I didn't see many, much from what the market was expecting, the 6 trillion on debt swap. I think it's more or less the market had expected.
Yeah.
So they have a 4 trillion on the local, housing inventory. I think the government has already said they're going to use special government bond, right? So I don't think it's too much surprising for the market. And also the 4 trillion, it's something, but it's spent, I think, over 5 years, right? It's only 800 billion every year, so it's not a really huge thing. So and other than that, we don't think any new information from that report. So I think it's more or less what the market had expected, or even in some extent it's undershoot. Right?
Oh, okay. Well, a lot of it also might come down to the details and the plan and how they implement that and the timing, how they roll it out, which takes me into your column, Shuli, because we have elections coming up, U.S. elections coming up. And your article argues that if it is Donald Trump that wins, that somehow influences how China is able to roll out their economic stimulus plan?
I think so, because when China first did the policy pivot late September, back then Donald Trump was still an underdog, right? And we just thought that it will be like the Democrat in the White House for the next 4 years, and then we'll continue on. And then China's stimulus package probably is, well, based on what the officials were talking about, it was very internal. It was very domestically focused. But 1 month on, suddenly Trump is poised to win at the 2-to-1 odds, according to the betting market. And we know, like Trump has said it himself, that, tariffs, the U.S. president has a lot of leeway in setting and imposing tariffs. And you just don't know. I mean, President Xi Jinping has reacted to Trump's unpredictable policy making before, and you just don't know if Trump is going to wake up in the middle of the night and say, let's slap 200% tariff on China or something, So I think they will want to ring fence and buffer China's industrial sector, especially against a possible Trump second term.
So if we do get stimulus that's bigger, a bigger number, or so, can we interpret that as good news or bad news?
I'm not sure it will be necessarily good news. I mean, the market likes it better if China, the government takes care of the housing problem or the municipal debt problem. But if the government talks about national strategic value or Made in China 2025, it's not necessarily good news, because we're already seeing industrial overcapacity because of all the subsidies. We see tension with the European Union, and if President Xi Jinping wants to go further down that route, I'm not sure it's good news.
Eric, I'll bring you in. What are the insights from your visit? How do things seem from on the ground?
It's interesting because we visited Fujian, a couple of new energy projects, solar panel, batteries, and I think it's probably not a big deal who wins the election for them, because either it's no matter Trump or Harris, I think they don't think the U.S.-China tension would see any, significant de-escalation. So, and I think for them, I think the biggest concern is, one is their new energy policies, industry policies, right? So that might have global implications for those companies overseas planning expansion. And I think another thing is they much worry about, well, will my company be put on the entity list, right? That's a very critical, thing for them. If any company is put on the list, then it's probably it's done, right? So I think they would, worry more about the industry policies and also the longer term, the U.S.-China tensions, right? Whether the tech restrictions will even escalate further.
That's the external threats. What about what we've heard domestically, this pro-growth pivot? How are companies reacting to that?
I think for most companies, they saw it as some positive, encouraging first step. Although many people are not sure whether this round of stimulus will going to, turn the situation around fast, but still, they think that they welcome the government's decision that at least showing the government is willing to fix things, right? So, and also they appreciate some forward guidance from those briefings that the government showed that they are willing to do more, right? If this time it's not working, but we are willing to do more, right?
Okay, team, thank you so much. Fantastic work. Check that out, of course, for our Bloomberg clients. Eric Zhu there, our Bloomberg economist, and Shuli Ren, our Bloomberg opinion columnist there. If you are, of course, a Bloomberg subscriber, you can catch up on all the interviews you might have missed here on their shows. TV Go is a function you run on your terminals. Also join the conversation by sending us instant messages to our team and our guests. So that's one way to reach us. The other one, of course, is
a QR code. That's a new thing. Take a look at the bottom of the screen there. Make sure to check it out. Take a picture of it right now and give us all your feedback for this online survey. And let us know what you want to see more on the China Show and on Bloomberg Television. Plenty more ahead. This is Bloomberg. Well, welcome back. A look at some top corporate stories now. McDonald's third quarter sales fell short of Wall Street's expectations on weakness in global markets, including China. However, the U.S. was a bright spot, and the fast food giant says a $5 meal deal improved perceptions around affordability. The results don't include an impact from the recent E. coli outbreak, though, linked to McDonald's quarter pounders.
Certainly very sorry if someone got sick at our restaurant for eating an onion that we used on our QPC. And I am relieved that I think we are now past this and on the road to getting back to serving our customers.
Elon Musk's artificial intelligence startup xAI is said to be seeking new funding at a roughly $40 billion valuation. A source says funding discussions are at an early stage and the details could still change. Musk says he aims to double the compute power of his startup's training cluster in Memphis, which he claims is already the world's largest. SoftBank founder Masayoshi Son says NVIDIA is still undervalued, pushing back against the idea of an AI bubble. The chipmaker has seen its market value skyrocket to over $3 trillion during the AI boom. Son told the Future Investment Initiative conference in Riyadh that the future of AI is much bigger, and NVIDIA is just one example. All right, we're taking a look at what it comes to markets here this morning, and the property sector seems to be doing quite well. So maybe on the prospect of what we're hearing from Reuters that China is considering this $1.4 trillion fiscal stimulus, as BE just told us, these numbers are pretty kind of no news at the moment, but still the market is moving with it. We're watching also some big moves there when it comes to in Japan. So Keiens Corp and Komatsu. So Keiens jumping on their second quarter results. Also, Komatsu, though, is heading the opposite direction. There's been a decline and slowdown in North America. Maybe that did disappoint the market. Plenty more to come. This is Bloomberg. All right, getting close to the bottom of the hour here in Tokyo and at lunch break, and looks like we're doing a pretty decent day here when it comes to Japanese equities. We're actually up more than 1% here right now. Right now, it seems to be really an earnings-driven story in a lot of ways, a lot of idiosyncratic some moves that we're seeing as well. But 153.41 still pretty weak when it comes to the Japanese currency here this morning, and yields in the JGB market are also ticking just slightly lower this morning, Dave.
Yeah, and how that's really carrying across the overall markets is, we're here in Asia, but really recently, the last 24 hours, all roads seem to keep leading back to the U.S. with an equity market that can't stop rallying. I think the Nasdaq hit a record overnight. S&P futures, obviously an overlapping constituency there. Following, I think, Alphabet earnings coming out, that's giving a boost there, and expect that to show up really in markets later when U.S. markets open up. Not to mention, events this time next week will determine, obviously, how far this rally can go short term. What is at least moving on the back of the narrative is really next week is things like gold, for example. The spot hit a new record, another one. Yet again, early this morning, crypto is, not crypto specifically, Bitcoin specifically is nearing its own record high that it topped back a few months ago. But as you can see, of course, the Bloomberg Crypto Index is up 4%, and spot gold, as you can see, is flirting with, let's call it even, 2,800. Right. So we had a conversation earlier on with UBS and Adrian Zuercher, who looks at their cross-asset strategies there. And we asked him really, where, has gold come up in his conversations with wealthy clients? And here's how he framed that answer earlier on.
I have to say it's a bit frothy at this level. We still see upside fundamentally, but it was going up in very short period, maybe a bit too quick. There might be some profit taking here and there, but I would say fundamentally there's still upside. You have central banks that are trying to diversify their FX reserves. You haven't seen very strong ETF flows, which we actually do expect will come in. We still expect the Fed to cut interest rates, and we still have a weaker dollar view, which should be supportive for stronger gold prices.
And let's bring in George Milling-Stanley, Chief Gold Strategist at State Street Global Advisors. He's here with us in our set and in this part of the world. Nice to see you and good morning. And what a time for us to be having this conversation.
It's a wonderful time to be representing gold.
I was about to say, you must be busy.
Oh, you're not kidding. That's why I'm here instead of being home in New York.
So what's going on?
I think three things really have been the major drivers so far. The first is very strong central bank buying, mostly from emerging market central banks, which have realized over the years that they are overweight dollar-denominated debt in their official reserves and underweight gold, which is one of the most popular things for their populations, with less than 5% of their reserves in gold. So for 14 straight years now, emerging market central banks have been net buyers of gold for their reserves. That's not going to go away anytime soon because they are still underweight in gold. The second thing, we've seen over the whole of this year a big revival in Chinese investment. And I think that's because the Chinese investor is conscious of all the problems in the real estate sector and is running scared of his local stock market. So the Chinese investor in droves has turned back to the traditional alternative, which for thousands of years has been gold. And then we've also seen, for different reasons, a big revival in Western world investment as well, in North America and Western Europe, because they're worried macroeconomically. They're delighted that the Fed has decided to cut rates, and therefore the dollar is going to soften. Gold tends to go up when the dollar softens. They're also very worried on the geopolitical front. So all of those things together, I think, have driven gold prices to this great succession of all-time highs we've seen.
So the dollar has been strengthening, though, and gold still rallies to record highs. Real rates are also higher. I mean, do I just ignore all that? That doesn't matter?
All sorts of weird things have been happening. You've seen the S&P 500 set a succession of all-time highs, which is a risk-on asset. You've seen Bitcoin setting a succession of all-time highs, the ultra risk-on asset, and gold, the absolute ultra risk-off asset. And that's a weird kind of situation. I think investors in gold have been turning to gold because they see this tremendous appetite for risk across the markets, whether it's equity buyers or crypto buyers. And the thought is, well, if everybody is so gung-ho about risk, maybe I should perhaps up my exposure to the risk-off asset because eventually they will turn to that. And I think that's really why we've seen all three of those things go up so dramatically.
I mean, you've covered gold for many years. Is gold a risk-on asset or is it a risk-off asset?
Gold is the ultimate risk-off asset. Gold basically offers you protection against a whole succession of risk. It doesn't have any strong relationship to anything else you'd find in a typical portfolio, so it's spreading your risk. It also is a good protector against sustained high inflation. It's a good protector against potential weakness in the equity markets. That's been demonstrated time and time again. And it also offers you some protection against potential weakness in currency, whether your currency is the Hong Kong dollar or the Chinese renminbi or the US dollar.
Gold ETFs, I think they were pretty slow to kind of gain traction. I think that's picking up. Is that sustainable, do you think?
Yeah, I mean, when we first launched Spider Gold shares 20 years ago, it was huge, very. It reached $1 billion in the first 3 trading days. The second billion took longer. It took 4 trading days. There's been a bit of a lag. We saw a very big increase in bars and coins investment over the last couple of years. That this year has turned into big inflows into gold-backed ETFs as well. So I think that I think investors are off to the races.
With this recent revival in prices, do you see a lot of the physical market and the supply there coming, a lot more coming online because of what's taking place? How does this affect how companies think, gold mining companies think about their plans?
Typically when we see very high prices, especially high prices at a sustained level, which we've seen now for a year or so, the gold mining companies tend to cut back on their supply because what they try to do is to mine to the average grade of ore in their mine, and the more the price goes up, then the more ore can be turned into gold. It becomes that way. So that supply often goes down, mine production often goes down as the price goes up. Now, we haven't really seen that yet. Gold mine production has continued to go, but that's mainly because gold mining companies are very inflexible. They set out a mine plan which might look to 30 or 40 or 50 years ahead, and they more or less have to stick to that. They don't have the flexibility to change course.
So that tells me that this whole demand story that we're seeing for gold right now, is that much more of a structural story than a speculative one?
Oh, I think so, yeah. I mean, I think there are very solid reasons historically why gold has done well in the kind of circumstances we're in today, whether you look at the macroeconomic circumstances or the geopolitical circumstances, or you look at gold's internal market dynamics, the 3 things I talked about.
Yeah.
So what are the risks there? There doesn't seem to be a risk based on the first 5.5 minutes of this chat just now. Like, what could change the story if gold can be anything you want it to be.
You want me to tell you what the headwinds are, don't you?
Yes.
I can tell. It's hard to see them, I have to say. It really is hard to see them. There's been some suggestions that perhaps when we know the result of the presidential election in the United States, been some suggestions that maybe some people had bought gold as a potential protection against whatever is going to go wrong there, and that maybe there'll be some profit-taking then. But I find that very difficult to believe. I've been listening to the promises both candidates have been making for the presidency, and it looks like more spending from both sides, which looks like higher deficits, which looks like more dollar depreciation, which looks like it's going to be good for gold. It's hard to see the headwinds right now.
How much is it still an inflation hedge?
I think gold, the relationship between gold and inflation is difficult. I think it's not a good predictor of inflation. It tends to follow inflation higher. And I think it's not a good protector against sudden sharp moves in the rate of inflation. So CPI at 9%, let's go buy gold. That's not a good idea. But when we have sustained high inflation, gold tends to perform. Inflation of more than 5% for more than 2 years, every time we've had that in the 50 years I've been looking at gold, then the gold price has gone up about 15% in nominal terms.
Interesting.
What is, one of the more common pushbacks we get here in the shows around, do I increase my allocation to gold? Is that it doesn't yield you anything. It's a non-yielding asset, for example. What's the best argument you can make against that?
Yeah, the non-yield bearing thing. It doesn't produce cash flow, except that it doesn't pay a coupon, it doesn't pay a dividend like a stock. But gold has, in the 50 years again that I've been looking at it, gold has shown you very strong price appreciation. On average, over that 50-year period, better than 8%. That's more than the bond market. So gold has shown you very, very strong price appreciation. So it doesn't generate cash flow, but if somebody wants to generate cash flow, they can sell gold because, as I say, it has given those great returns.
Okay, I think we want some numbers now and targets. We've already gained, a third this year in terms of gold prices? How much more upside are we talking about now?
I am not as optimistic as certain people on Wall Street are. I mean, a lot of people on Wall Street have been talking $3,000 gold before the end of the year. I'm not going to predict that. I think we will probably see the $3,000 target at some point, but my guess at this point is it probably won't be until next year. But I think that we can see further upside from here, close to 2,800. It's difficult to see how much we'll see, given that we've already had such great gains.
Yes. George, it's great to have you here in the region, and good luck on your travels here in Asia. George Milling-Stanley, their chief gold strategist at State Street Global Advisors. We're checking one stock in particular, Korea Zinc. So we're getting some news now of this share sale. So seeking to raise about 2.5 trillion won and issuing about 3.73 million new shares. So that is why the reason why we're seeing that big slump on that stock here right now, down some 24% for Korea Zinc. And all this week, we're going to talk about U.S. election risk and the like here, and what it's really going to be looking at and what this result could mean for Asia. Today, Avril Hong explores how a Trump or Harris administration might affect one of the world's most dynamic blocs, ASEAN.
President Biden may have skipped this year's ASEAN summit in Laos, sending his Secretary of State Anthony Blinken in his place. But there's a long-standing and strategic relationship between the U.S. and Southeast Asian nations. The U.S. is ASEAN's #1 source of foreign direct investment, funding health, security, and economic projects in the region to the tune of $14.7 billion since 2002, along with $1.9 billion for humanitarian aid. Trade in U.S. goods and services was worth an estimated $500 billion in 2023 alone. But there are questions about future U.S. enthusiasm.
Whether it is Trump or it is the Harris ticket coming on board in January 2025, I think there's a concern that because the mood in America is turning inward and the mood is not receptive anymore to open multilateralism, that the American people expect their president, be it President Trump or President Harris, to be taking care of themselves first.
Defense remains the beating heart of the relationship. The U.S. cooperates militarily with Vietnam, Singapore, Indonesia, Thailand, and perhaps most significantly, the Philippines. With tensions on the rise in the South China Sea, and frequent clashes between the Chinese Navy and Philippine Coast Guards over disputed waters, Washington and Manila's Mutual Defense Treaty has already been put to the test. But if Kamala Harris wins the White House, her newly installed administration could resist getting further involved.
In terms of policy, we're going to see a lot more coherence in the way she articulates U.S. policy towards the region. So we can take comfort in that. But she faces a very harsh political reality back home. And that's something that she has to balance out.
For Donald Trump, China continues to loom large, and he may demand ASEAN nations fall in line with his protectionist policies.
That relationship in terms of trade is probably a bit of a dampener. And in terms of defense or even just personal engagement, I don't think he has that patience to be engaging with the region.
Whoever wins the White House in just a few days' time, the stakes for ASEAN are high. Avril Hong, Bloomberg News.
And still ahead, how China is making steady progress to dominate industries of the future despite years of U.S. tariffs and export controls. Our big take coming up next. This is Bloomberg. Let's get to our big take here this morning. China has managed to achieve a leadership position in several key technology industries, including the likes of EVs and renewable energy. And that is despite U.S. efforts to slow those advances, especially in areas that threaten military superiority. That is the topic of today's big take. And for more, we have a team on board here from our Asia government and economy correspondent, Rebecca Chung-Wilkins, also Bloomberg Intelligence senior analyst, Robert Lee. Rebecca, I'll start with you. Key question, has the U.S. failed to contain China?
Well, it sort of somewhat depends on what areas of technology you're talking about, but by and large, we can answer no. So if we look at these 13 key technologies under China's own Made in China 2025 goals, so that's the industrial policy that President Xi Jinping laid out back in 2015. 5 of these key sectors are global leaders, 7 of them are catching up fast, and 1 is a laggard. Now, the big exception to that is probably semiconductors, particularly these really advanced chips where export controls and moves to try and prevent the transfer of US technology have been relatively successful. In part, though, because China was already some ways behind. And of course, the other element here is that all of these restrictions have incited China to pour billions and billions into trying to accelerate the indigenization, the localization of that chip industry.
And, Robert, that takes us very nicely into your wheelhouse here. Here are the 13 technologies. China's top of the world in 5. They're competitive in 7. They're laggard in 1. Talk to us a little bit more about chips.
Okay, on the semiconductor front, there's always a focus on the leading edge, the bleeding edge, the high-end processors, the NVIDIA-like products, etc., which is important. But I think we shouldn't forget the mass market, because the majority of chips sold in the world go into fairly mundane from articles, from air conditioners to automobiles to toasters to kettles, you name it. And that is a massive market. And as you appreciate, China is the workshop to the world. So I think, the focus of what China is doing strategically at the moment is to build self-sufficiency within those mass markets where it can still make a good profit. Maybe the margin is not quite as high at the bleeding edge, but I think that potentially gives the country a good foundation. And this is a generic Asian model. If you look at the Japanese car industry or the Japanese the motorbike industry, they did the same thing. They competed at the low end, built critical mass, and then used that as a platform to move upscale. So I think that's what China's doing. And the way things are going at the moment, it's steady as she goes. It's a long-term, maybe multi-decade ambition or plan, but it's making very good progress.
What about the AI front in terms of who's outperforming right now in terms of using these sort of Chinese-made chips?
Yeah, I mean, with AI, you can divide it into hardware and software, and clearly the States, NVIDIA, is leading on that front for the AI accelerators. And obviously, given the export controls, there were concerns earlier in the year that the restricted access to these AI accelerators would curtail China's access. But what has happened, obviously, given that challenge, that has spurred Chinese companies and the government, or supported by the government, to double down their efforts. And so what they've done is move to sort of more focused, more computationally or less computationally intensive models that can work more easily and more effectively using the lower-end domestic chips. That's enabled them to continue their developments at a fairly rapid rate. So I would say China is firmly positioned now as the global number 2 in software, and that's confirmed by third-party evidence from US or European sources, because the technical barrier to entry on the software side is substantially lower than on semiconductors. Again, I don't want to trivialize it, but it is far easier to train a developer to code than it is to deliver chips at the atomic scale. So I think, again, China's doing extremely well on the AI front, although the US is likely to remain the leader, for certainly over the next few years or so.
Yeah, and, how far behind is China as a number 2, right? Because, let's go back to the bleeding edge, right? So, like a chip design, how far behind is China in years? And, how far behind is China from having its own TSMC? How far behind is SMIC from TSMC?
Yes, on the foundry side, SMIC and Huahong, and there are some others, are the equivalent foundries. So they're, how far are they behind? The big roadblock for them, or bottleneck, is the access to bleeding-edge ASML EUV equipment. So obviously, given the export restrictions, they can't access that. They are several generations behind. But again, with the support of the state behind them, and again, China has an enormous number of engineers at its disposal. I think over time, and with the support of the government, they can narrow the gap. But they are 5-10 years behind. It's quite difficult to put a firm number on it.
When it comes to this U.S. election, I mean, we've always long talked about China. I guess they don't care as much who wins as president, because either way, there's still that tariff risk. But how do you see this faring out, Trump versus Harris?
I think both scenarios are bad news for China, but they do present quite different sort of approaches. So if we think about Trump, of course, we've had this 60% figure bandied day in, day out. And of course, that would be a significant hit to the Chinese economy. They have figured out other ways. We look at transshipment, this idea that trade always does find a way to get through. But Kamala Harris has taken quite a different approach. She's focused more on export controls and the national security elements around that. Of course, we expect her to be more of a status quo figure. She has said that, if we saw something like a 60% tariff on all Chinese imports, that would effectively be a tax on the middle class. So 2 quite different approaches here when it comes to China.
Concerns over, I'm not sure how to phrase this, potential war, potential conflict playing into, these bilateral ties.
Yeah, this is interesting. I mean, this has become an increasingly explicit part of the discussion when it comes to the US-China rivalry. It sort of used to be in the background somewhat. It's become much more focused and much more explicit. So Jake Sullivan in 2022 talking explicitly about the use of export controls as a tool to degrade military battlefields. And we know Beijing officials, in addition to sort of seeing things like lithium and solar panels as a key part of the new drivers of growth and so on, it's also a security element. It's also about ensuring and improving China's self-sufficiency when it comes to energy in any potential sort of war scenario where we saw other countries trying to sort of restrict or sanction or limit its access to oil and gas.
All right, great stuff. Rebecca Chung-Wilkins, our Asia government and economy correspondent. I also want to thank Bloomberg Intelligence senior analyst Robert Lee. You want to check out the big take today, and then there's also another report, Made in China 2025, from Bloomberg Intelligence there. That is on the terminal right now.
Yeah, and by the way, in case you missed our plug earlier on, here's another chance. Whip out your phones. There's a QR code coming up bottom of your screens. It works, by the way. I've tried it. Check that out. Tell us what you think about our shows. Short and simple. This is Bloomberg. All right, welcome back. We are continuing really this intersection between politics and markets. And it shows up really in one stock in China. And these Trump trades, why soft? Okay, if you've been following our shows for some time, you know what this stock is all about. So the stock, the name, in Chinese translates to Trump wins big, or sounds like Trump wins big. And why it's up 10%, I don't know. But certainly going into elections next week, that is enough for bidders to bid the stock higher.
You talk about the betting markets, right? That
Yeah.
seems to be pricing in more of a Trump victory. That's why some of these Trump trades are emerging, and that's why you're seeing it, and even in some of these Chinese stocks right now. In terms of earnings, we talk about Chalco and that third quarter miss. Stocks down some 8%. BYD is a big one coming up here. Looks set to surpass Tesla when it comes to total revenue. This is Bloomberg.